What a long, strange day it was on Wall Street. The sell-off that began Friday whipsawed the market again. In one furious 15-minute stretch, the Dow Jones Industrial Average dropped and then recouped 700 points. It ended with a loss of 1,175 to finish at 24,345. That's a drop of more than 4.5%, the biggest percentage drop since 2011. The Nasdaq fell 273 points and the S&P 500 gave up 113. We try to sort this out now with Gillian Tett, the U.S. managing editor of the Financial Times, where she's also a markets and finance columnist, and Diane Swonk, chief economist for Grant Thornton in Chicago. Thank you both for joining us. Diane, let me begin with you. What happened today?
Well, what we're starting to see is reality finally hit into the fact that the markets were priced to perfection and the economy is not perfect. In fact, we sort of saw a sort of euphoria almost like 1999 out there with this roaring stock market, but we've got a 21st century economy, an economy that's doing well, but it also has a price to that stronger growth, and that's higher interest rates. That's something the markets hadn't counted on, is that not only are we going to see some inflation going forward, but with the warming trend in wages, we will also see higher long-term interest rates, and that's just a cost of a better economy.
Gillian Tett, reality setting in?
Absolutely. I mean, I was in the World Economic Forum just a few days ago in Davos, talking to a lot of CEOs and hedge fund traders, and the comment that almost everyone made is this cannot last. It's too good to be true to have the equity markets rallying day after day and to have the volatility, the amount of the market swing each day, so incredibly low. And what sparked this latest sell-off really was a realization on Friday that we're just starting to see the first signs of inflationary pressures creeping into the US economy. And that left many traders thinking, well, actually, these extraordinary conditions that have been supported by cheap money from central banks, that can't go on forever.
Diane, but we've seen this, the employment numbers getting better, wages getting a little better, and last month the big tax bill being passed, we knew that there was going to be a lot of borrowing ahead. Why did it suddenly come into focus now?
Well, I think there's a lot of things. One is that employment report on Friday, today's report on the service sector doing as well as it has since 2005. Those things all together suggest that the economy is finally experiencing a warming trend, that the sort of Goldilocks scenario that the world would be forever with low interest rates and no wages for Wall Street. Now we're shifting the baton to Main Street a bit, although I think, the wages are still a hope. We still need sustained wage gains out there, but that reality set in. Also, this is a global phenomena. I think that's very important, is that other economies are also picking up, and you're seeing other central banks not only lift their foot off the accelerator, but talk about hitting a brake. This is a very big shift from what we've seen for the last sort of 8 to 9 years.
And Gillian, you talk about that volatility. The selling really increased in the afternoon. It slacked off a little bit, but then increased again at the close. Is this an indication of program trading?
Absolutely. I mean, one of the really important things to understand is that right now, people reckon that about almost half of all the money in US equity funds are in passive funds. That means there's not a human involved in actively manage them, it's computers. And on any given day, you can get sometimes 2/3 of the market driven by computerized trading. And a lot of these computerized programs are essentially set up to sell when conditions get very choppy. So everyone talks about self-driving cars. What we're kind of seeing right now is self-driving markets where a lot of computer programs are jumping in. And in addition to this, there's a particular trade that's been incredibly unpopular for the last few months called trading on volatility, basically placing bets that volatility is going to carry on being very, very low in the markets. What happened in the few hours at the end of stock market trading today, and it's continuing even now, is a lot of those bets went really badly wrong. And there's a type of fund which has borrowed heavily to place these bets, which is really suffering right now. So just as in previous market crashes and swings, we've seen some hedge funds and funds being knocked out by these peculiar movements, that's what's going on right now, and that's making the trading doubly peculiar.
And Diane, I mean, the stock market, the U.S. markets have been very high for a while now. Has the market seemed to be looking for a bottom today? Has it found it, or do you think we're going to see the selling pressure continue?
Well, it's hard to say because we are still dealing with this reality. It's kind of interesting is, the reality is that now the markets really believe the Fed's going to raise interest rates, that interest rates are going higher. We also have a lot of debt. Treasury announced last week that it was going to have to issue more debt because of the tax cuts to finance those tax cuts. I think all of that coming together is really important, and so it does set the stage for more volatility going forward. I agree that the volatility comments that we heard out there that Julian pointed out are very important. I think it's also really important is that we saw no one hedging their downside. As she said, many people were on the wrong side of the bets. People were like driving without a seatbelt in this market. They were so confident it was only going to go up. And I think that's a really critical point as well. Does that mean we're done with the correction? I don't know. If I knew that, I would own my own island in a place that doesn't have hurricanes. But the reality is that the economy's solid. We are talking about an economy that's sort of handing the baton to Main Street finally. And as we gain traction in wages, that will be very good for the economy. We do see some self-feeding momentum out there. That's something we welcome.
Diane, I should point out that late today, the White House put out a statement echoing that, saying that the fundamentals, the long-term fundamentals of the economy remain strong. Diane Swonk and Gillian Tett, thanks so much for joining us.
Thank you.